Let's bring in Anastasia Amoroso, head of cross-asset thematic strategy with JP Morgan Private Bank, and Steve Grasso is director of institutional sales and a fast money trader. Good to see you both. Anastasia, I'll begin with you first. So we had this best week since the 70s on the same day that employment numbers are horrific. Does this make any sense to you?
It does make some sense. And the reason for that is we really had at least 3 game changers that happened this week to offset the negativity of the numbers of initial jobless claims. And those game changers are massive monetary policy support, massive fiscal policy support. And by the way, the two of them, the combination, how it works together is very potent. And then we finally got some better news on the COVID infection front as well. So it is no wonder that the market is shaking off some of the bad news from payrolls. So to just emphasize the points that Steve made, the monetary policy unveiled by the Fed, especially today, is truly unprecedented. And what the objective of that, I think, really is to make sure that nobody slips through the cracks to the extent possible. And one of the vulnerable places that the market's worried about is the high yield market and what could happen to the defaults there. But because there's now up to $600 billion of loans that will be available to these mid-sized businesses, that captures a lot of what are high-yield issuers and the leveraged loan issuers. So that was a very game-changing aspect, and no wonder high-yield rallied very strongly on the market today, rather. And then you combine this with the fiscal side. We know that the CARES package is massive, $2 trillion, but you couple that with the Fed leverage, and you're already starting to see the impact of that. In full, they could probably add another $4 trillion to the stimulus that is the CARES Act of $2 trillion. And so we saw $2.3 trillion of that already added today. So that's how I explain this rally that we had. And I think there's some durable, sustainable features to it. And chances are we have seen the low for this particular crisis.
So, Steve Grasso, did the Fed, as Anastasia says, take a retest off the table today?
I think the Fed definitely took a retest off the table for today. And I think it's going to be very hard to test those lows, Scott, in the next 30 to 45 to 60 days. But to Anastasia's point, can you hear me okay?
I can, yep. Go ahead.
Okay. So to Anastasia's point, is if the coronavirus numbers didn't start to get better, they can do all the bailouts in the world and it wouldn't matter. So it was a confluence of events that the Fed really bailed out the junk bond market, which that was the biggest fear that was going to overlay on the rest of the economy, the banks. And if you look back to 08, 09, the Fed and everyone else in this country went to school on that. That's emboldened them to take the actions that they're taking now. So back then, it was too big to fail. Now it's nobody will fail. So we're rewarding companies that went into this weak and are coming out weak and won't be allowed to fail. And the stronger companies will be aided because they will put up numbers that are satisfactory. No one's going to have any earnings. So we're not nervous about economic data, earnings at this point. That day will come. So to your original question, for the next 30 to 60 days, a retest seems unlikely. But once everyone goes back to work and we start to see those infection rates and deaths probably don't plateau and rise again, that's when you're susceptible to the retest.
Anastasia, can we believe what we've seen out of the Russell 2000? The rebound has been quite dramatic. These are the smaller companies in this country, the ones who may be more susceptible to problems because of the virus and the shutdown.
Sense that those would be the companies that rallied the most today and actually rallied the most this week. Because if you think about, again, what the confluence of policy does, it supports the weakest links. And that's exactly who's been helped by those policies today. So if you believe that the activity from this point forward is going to improve, then I think absolutely you can believe in the rally that we're seeing in the Russell 2000. If we start to shift our mentality from late cycle, which was so last year or a few years ago, to now this is a beginning of the new cycle. So you look for things that perform well when you're recovering from low levels of activity. It tends to be small caps, tends to be value, tends to be cyclicals. Now, having said that, I think it's probably a little bit too early to step into some of those places, but we have to start thinking about two types of opportunities. On the one hand, well, two or three types of opportunities, but on the one hand, you've got these left behind companies, some of them are small caps, but also things like airlines and transportation methods and vacation places and all these COVID underperformers. By the way, they're some of the best performing companies this week. I think there's more catching up of those companies to do as eventually we go back to work and we go back to life. That's the first thing. The second thing, we do have to think about the long-term beneficiary of this, which are all companies that were already well-liked. But a lot of the artificial intelligence players are at the forefront here, helping us deal with this issue. And this could be AI companies that are helping us forecast the spread of the virus. These can be robotics companies that are helping us disinfect the surfaces. These can be the companies that are actually helping us accelerate the pace of innovation in healthcare as they apply AI to finding, let's say, the shape of the spike protein. Right. So you definitely look at that. And then the last thing I would mention, which perhaps should be at the top of the list, is credit. Given the intense support that we're getting from the policymakers, investment grade, high yield preferreds would be the top of the list here for me.
Good to have you both with us tonight. Anastasia, Steve, thank you so much. We'll talk to you again soon.